Thank you for joining us for this webinar on the economic impact of COVID-19. So in 2020, Coface Economic Research Department had warned that the main economic risks and the main risk for the global economy would paradoxically not be economic ones. We were thinking in particular that political risks would grab the headlines, especially with the trade war between the US and China. We were also thinking that the environmental risk would have an impact on the economy. We were right on assessing that the main risk to the global economy would not be economic, but what we didn't see coming is that a crisis would come from health and sanitary risks. So just in a few words to come back on what happened. We've been from the COVID-19 shock has evolved from a localized Chinese epidemic to now a global pandemic, which is now forcing close to half of the world population to stay at home. We've seen confinement measures being stepped up globally and shutdowns being conducted at a very large scale. So you can see on the left-hand side chart how the pandemic has evolved so far, and you can see that it's no longer a Chinese problem, it's no longer a Chinese virus. You can see that now the epicenter of the epidemic is now mostly in Europe and in the US. We had some positive news and we have some hopes that we are close to the peak of the crisis, of the health and sanitary crisis in Europe. We're still in the middle of this crisis because it seems that North America is experiencing this crisis with a delay. So we can expect this crisis to continue for quite some time, but I will detail in a minute our scenario for the overall situation. What I want to insist on with the table on the right-hand side is how do we recover from this crisis? Because right now, especially in North America, we're very much focused on the global economic impact, but a very important questions will arise in the next weeks is how do we recover from it? So you can see here how that after 2 months of intense lockdown in China, most companies in China reported that they are close to full capacity. They have recovered and resumed work at 75% of their capacity. So it means that there's a recovery from this, but it also means that you cannot come from a complete standstill like we are now to going back to full economic activity. What you can also see is that the Hubei region and where the epidemic started is lagging behind, and it's still being very, very slow to resume work there. So if we move on to the next slide, you will be able to see how we built our scenario for 2020. So in Q1, we've seen the peak of the health situation in China. Lockdowns have started in Europe and North America, so with a slight lag in North America. Then we're entering the second quarter. We expect the shutdowns to start ending by late April, early May, at least in Europe. It will probably take a week or more, or 2 more additional weeks in North America. Then it will follow with a very gradual reopening of the economy. And it's very important to insist on this aspect. The reopening process will be very gradual. We expect this gradual reopening process to go on in Q3 and Q4 to avoid. We've seen with Hong Kong and Singapore that it was difficult to just reopen everything at once without being exposed to this second wave, which is our risk scenario, which would mean a double dip in economic growth. So in terms of economic growth, how does it translate? So you can see on the right-hand side chart, quarterly GDP growth at an annualized and seasonally adjusted rate. So you can see in the second quarter of 2020, we're forecasting close to a 19% decline in GDP. So it will be by far we expect these quarterly figures to translate into a minus 2.9% contraction in GDP for the US, which will be the worst outturn for US GDP growth since 2009. And we expect Canadian GDP growth to also contract by minus 3.5% in 2020. So in addition to the shutdowns, Canada will also suffer from low oil prices and its exposition to the risk and to the slowdown in the US. If we move on to the next slide, you'll be able to see that that this trend of negative GDP growth is matched all over the world. Last year, in 2019, 11 countries experienced negative growth. We expect this year that at least 68 countries will experience negative growth, including the US and Canada. It will drive the sharpest downturn since the Great Recession. And you can see that we are forecasting a decline in growth of 1.3% in 2020. This decline will be driven by Europe, and especially by the Eurozone, that we expect will decline by GDP. We expect GDP growth in the Eurozone to decline by more than 6%. We also expect a very sharp slowdown in China that will also contribute to this slowdown. So this global slowdown is also translating into lower export volumes at the global level. So you can see that we're forecasting a 4.3% decline in global export volumes this year. So it's down from a decline last year that was prompted by trade tensions and the industrial slowdown in Europe. It will be the sharpest, the 2020 slowdown in trade volumes will be the sharpest one since 2009. So this is the outturn from our model. And you can see that we're still far from the close to minus 20% that was reached in contraction in 2009. But we can expect this minus 4.3% to be maybe a bit optimistic for global trade volume. So there's a lot of uncertainty, and we should expect downward revisions to this figure in the next month or so. So this very, very bleak outlook and very dark picture will translate for businesses into the highest level of business bankruptcies since 2009. If we move on to the next slide, you will be able to see our forecast for business insolvencies for 2020. You can see that we're expecting world business bankruptcies to increase by 25%. As I mentioned, the highest outturn since 2009. It's up from our forecast, from our January forecast, which was already for an increase of 2%. So you can see how the COVID-19 has derailed in a huge way the scenario for 2020. You can also see from this chart that North America, and especially the US, will lead these double digits and broad-based increase in bankruptcies, with close to 39% increase in business bankruptcies. This is the highest outturn since 2008, when business bankruptcies increased by more than 50%. So the question is, why will we see this increase in business bankruptcies? Well, the answer for the Coface Economic Research Department is that we're facing currently a triple shock that will affect the global economy. The triple shock includes a shock on supply, a shock on demand, and a third shock that is derived from this dual shock on commodity prices, which will also translate into a higher level of bankruptcies. So first, with the next slide, we will see the supply shock. So as I mentioned, this epidemic started in China. China is vital and plays a pivotal role in the global economy. It's responsible for more than 25% of the global industrial output. So already this shock in China was having an impact on supply chains. You can see from the left-hand side chart, which shows a survey conducted by the Institute for Supply Management, that close to 3/4 of US companies reported in some capacity that their business operations were were experiencing supply chain disruptions. Obviously, with the shutdowns being implemented at the global level now, we're seeing this supply chain being at a much wider scope. So it means that what started in China is now affecting the entire world. In North America, it translates, for instance, into shutdowns for the biggest automakers in the country. So once we said that, we've tried to look at which sectors are more exposed to these supply disruptions and to these supply chain disruptions by looking at inventories level. You can see the result of this analysis on the right-hand side chart. And you can see that the textile clothing industry is particularly exposed to supply chain disruptions because the model of fast fashion that has dominated the sector in the past decade is forcing to a low level of inventories. So it means that it will be one of the first sectors to feel the impact of these very high level of supply chain disruptions. Other sectors being affected is the construction sector and, interestingly, the pharma sector. This is why we're seeing a lot of discussions around protectionist measures surrounding health equipment. And lately, we've seen some squabbles between the US and Canada surrounding face masks. So what is also interesting to note from this chart is that even though the US has the biggest tech companies in the world, we can see that it's very much dependent it has the lowest level of inventories compared to its peers. It means that it's very much dependent on supply chains, especially supply chains in Asia. So that's for the supply shock. But there's a second shock that is also going to have a long-lasting impact. It's the demand shock that I'm going to develop in the next slide. So with the next slide, you can see the impact of this crisis on the labor market. The labor market in the US has demonstrated since the last recession in 2009 a lot of strength. The unemployment rate reached a 69-year low at 3.5%. This level was the level of unemployment that the US had in February 2020. It supported consumer confidence. That's what you can see on the left-hand side with the blue line. And you can already see with the March figure that was released last week that unemployment rate has increased by close to 1%, by one percentage point, sorry, and that consumer confidence has started to plummet. This is the first consequences that we can see on the labor market. And we can expect these figures to continue. We can expect this unemployment rate figure to continue to increase in the next few months, because as you can see on the right-hand side chart, weekly jobless claims has reached record levels. The latest figure in weekly jobless claims shows that close to 7 million people have filed for unemployment insurance in the week to March 27. It's close to 10 times the previous record high that was recorded in October 1982 of 695,000 people registering for jobless claim. One silver lining of this data is that many of these jobless claims might be temporary layoff and not temporary redundancy, which means that the unemployment rate could surge to record level quite soon, potentially breaching 10% as soon as April or May. But the other good news is that once we get out of this crisis, we might see the unemployment rate fall more rapidly than it did after the 2008-2009 crisis. And this weakness that we're going to see in the labor market is going to have an impact on consumer spending, and that's what we're going to see on the next slide. You can already see from the next slide on the left-hand side that consumers' behavior has changed and is changing because of the COVID outbreak. You can see that in February, there were only 13% of people who were changing their behavior as a result of the outbreak. In March, it's close to 3/4 of the population that is adjusting its behavior. And it means adjusting its behaviors means putting off large purchases. So that's going to impact, for instance, the auto sector very dramatically, because we now expect auto sales to decrease by close to 3/4 in April and in Q2, and for each month of shutdown that we will see. But you can also see the very large impact on the transport sector, with close to half of the population surveyed that canceled or changed its travel plans. You can also see on the right-hand side chart that the income has already been affected by the crisis and by the COVID-19 crisis. You can see that close to 73% of surveyed Americans reported that their family income has been reduced as a result of the coronavirus outbreak. More interestingly, you can see that close to 1/4 of the population has seen its income very significantly reduced because of this outbreak. What is also interesting to note is that when you look at the breakdown by income group, you can see that the lowest income groups are more exposed to these risks. It's because obviously industries with low-wage workers are more affected by this crisis in the hospitality, retail, and entertainment sector. If we move on to the next slide, you will see that this shock on demand and supply is particularly affecting a broad range of two sectors. This dual shock is affecting all sectors of the economy and is not discriminating any sector. But you can see that the transport sector on the left-hand side chart is seeing a very dramatic impact. The TSA, the Transport Security Administration figures, daily figures for people going through the checkpoints, and when you compare it from 2019 to 2020, you can see that from an average of about 2.5 million people going through checkpoints in 2019, in early April, this figure has fell as low as only a few 100,000 of people crossing these checkpoints. So it indicates that the air travel industry will be one of the sector most affected by the COVID-19 shock. On the right-hand side chart, I wanted to highlight the evolution of seated diners at restaurants, because it shows the unprecedented shock that we will see on the retail, hospitality, and entertainment sector. What this chart shows on the right-hand side is that basically seated diners at restaurants has virtually fell to zero as a result of the confinement measures. And we can expect this very sharp impact to be the same in many other sectors. So obviously textiles and apparel stores will also feel this impact of zero of their sales falling to zero as long as the shutdowns continue. And that's what I wanted to highlight. These few sectors are going to be very badly affected by the COVID crisis. The third sector that I wanted to highlight is on the next slide. It's the energy sector, because as a result of this dual shock, and especially of the demand shock, we've seen a very dramatic fall in oil prices. So you can see on the left-hand side chart that WTI crude oil prices have fallen quite dramatically by close to 60% since the beginning of the year. So they were at close to Brent prices were above $60 in January, and now they are navigating between $20 to $30. So it means that the energy sector in North America, and especially in the US, with the shale sector that was experiencing a lot of difficulties as a result of a high level of debt, and because they had contracted a lot of debt to try to increase production, well, it will face even greater uncertainty. And we expect, you can see on the right-hand side chart, that the bankruptcy filings had already increased in 2019. We expected this level to increase in 2020 as well. And it will continue to increase in 2020, and probably even more dramatically than in 2019. It will probably exceed the 2015 level of 44 bankruptcies in the exploration production sector and branch. We can expect the highest level of bankruptcies, but also in addition to higher frequencies of bankruptcy in the sector, we can expect higher and bigger bankruptcies. We've seen, for instance, this last week that Whiting Petroleum had filed for Chapter 11 bankruptcy. So this triple shock is having an impact on the three, is having a particularly hard impact on these three sectors in North America, but it will affect all sectors as mentioned. Hopefully, and that's what we can see on the next slide, is that there's an unprecedented shock, but the policy response is also unprecedented. You can see on the left-hand side chart the details of the fiscal stimulus package that was passed about 2 weeks ago. You can see that the federal state will proceed to one-time payments to American households, and hopefully it will help to support the income of the most vulnerable groups of the population, which we have seen in one of the previous slides are already being affected by the coronavirus outbreak. What we're also seeing is that a large part of the support goes to small businesses, with close to $350 billion US being earmarked in loans for small businesses. And Secretary Treasury Steven Mnuchin indicated that they wanted to extend this support by $250 billion US. In addition to this support, we're seeing a $500 billion support in loans and loan guarantees to distressed industries. You can see that in the Fed program, $444 billion, and in the loans to the airline industry that will also benefit from grants. In addition to the support from the federal state, the Fed is also taking unprecedented steps. You can see that the balance, the Federal Reserve balance sheet, has increased by more than 1.3 trillion US dollars in the past few weeks. This increase is already as important as the one that we've seen between 2012 and 2014. So it means that the quantitative easing policy of the Federal Reserve to make sure that there is enough liquidity in the system is being stepped up, and that the Federal Reserve is doing whatever necessary to protect the economy and to try to cushion the impact of the COVID-19 crisis, and also to help the recovery. So I wanted to end this presentation on this positive message. And I wanted also to thank you all for your attention. I think we can now open the floor to questions. As mentioned in the introduction, I will also be joined for the Q&A session by my colleague Ken Moyle, our director for the regional director for underwriting, that will help us to answer any question that you might have. Thank you again.
So as a reminder, please be advised that you can use the question pane on your panel to type your questions. We have had a few questions about whether or not we'll be distributing the presentation following the call today, and the answer is yes, we will distribute to the attendees. Here's a question for Ruben. Ruben, could you expand on what leads you to believe China has fully recovered?
Well, it seems that China has not fully recovered. As we have seen in one of the first slides, companies report that they've been able to be back to about 75 to 80% of their capacity before the crisis. Another important aspect is that, and what you have to have in mind, is that Wuhan, where the epidemic started, has only ended the lockdown yesterday after two and a half months of intense lockdown. So it gives you an idea of how long the shutdown of an economy can last. And it also indicates that it's very difficult to restart the economy altogether. Well, China is also facing some very specific issues because obviously with the epidemic being now a global pandemic, global demand is at a standstill. So demand is very low and Chinese manufacturers are suffering. So we can expect the recovery in China to gain some pace in the second half of the year when global demand starts to recover. But again, since we can expect that the demand shock, and with many people that will be laid off and having their income being cut because of COVID-19, that demand and the recovery in demand will remain cautious in the second half of the year.
Okay, thanks, Ruben. We're seeing quite a few questions come in, so the likelihood that this call may run a little late here. So I'll start in on the questions here. What is cash flow around the world looking like presently? And perhaps you can also reflect a little on how you see liquidity.
So on cash flows, well, it's a bit difficult to answer this question right now because one of the problems we have is that, well, the economy is virtually at a standstill still. So even payments, even some payments are being delayed or just being suspended. So it means that cash inflows are stopped, and even some cash outflows are being stopped to try to protect some businesses. So we don't have exact figures yet on how the overall situation is looking at, but what we can say is that basically, well, cash flows are at a stop. In terms of liquidity, well, we've seen with the Federal Reserve that they've stepped up some programs to make sure that there's enough liquidity in the system for all companies. But what we will probably see is that this liquidity are not really necessary now because, well, everything stops and everything's there's not anything working. But when the economy starts recovering and when companies actually need more liquidity, that's when we will see if these programs and if the quantitative easing program of the Federal Reserve to ensure that there's enough liquidity in the system is enough. We've seen already that there's a high demand for the small business loan program of the federal state, and that banks were already struggling to implement this program. But it was not because of liquidity issues, but more because of a lack of details on how exactly the scheme was working. I believe that we will see the liquidity tensions being higher in Q3 when the economy starts to reopen.
I would just add to Ruben's comments on the corporate side. We've seen many companies draw down the full availability under their revolving credit agreements to give them liquidity to pay bills while they have zero revenues coming in for a period of time. So they've acted in a defensive manner, and many have either canceled or delayed dividend payments and stopped share buyback programs to preserve liquidity.
Okay, thank you. We have another question here. Would you expect a high inflation as a consequence to the relief packages?
No, quite the opposite actually, because obviously the fiscal stimulus measures are coming on the backdrop of very low demand, and very low internal demand will drive inflation down. So that's the first rationale behind our forecast, that inflation will actually be lower than in 2019. And the other rationale is that prices are very heavily influenced by fluctuations and by the evolution of oil prices. And as I mentioned, oil prices are plummeting, and we're not expecting a sharp recovery anytime soon, unless there's an agreement to curtail oil output at the global level. So that's why we're expecting inflation to come down this year.
Thank you. How will Coface be evaluating retail credit during the next 6 months?
Well, retailers, particularly brick and mortar retailers, have had challenges already. Threats from e-commerce, impact of price of goods due to the trade wars, and certainly going weeks or months without any operations is going to hurt them. We've seen retailers cancel orders from our policyholders, ask for delayed payments. We've seen some recent bankruptcies, and we expect to see higher bankruptcies among the marginal retailers within the next 6 to 12 months. So we have to be cautious on those that were barely making it to begin with, and now this could be the coup de grace, the lack of revenues for a period of time that put them into bankruptcy. And it's uncertain with the current environment, even if they go into bankruptcy, how many of them will be able to emerge and have a successful business model.
Thanks, Ken. Here's another question. China relies heavily on exports. How are they coming back to 80% capacity if there is such a huge demand shock and there's low demand around the world for products?
Well, first, they are very dependent on exports, but they also have very high demand. I do agree with you that there's some doubts on the reliability of these data. These data are reported directly by companies, and they might be overestimated. What we've seen, and our Asian economists have looked at also the migration figures. And basically what they've seen is that the migration figures does not match also this level of companies being back to 80 or 75% of capacity. So it means that it means basically that there are some staffing issues now in China that makes this data not very consistent. But again, that's the best we have.
Okay, thank you. Are you seeing companies demanding changes in payment terms? And if so, how is Coface responding?
We've seen delays in payments. We've seen requests for extension of due dates. We have not seen changing, permanently the terms of trade. Where it makes sense, we've been accommodating our policyholders and allowing them to extend the term of the due date rather than submitting claims. So we've been accommodating in that sense.
Again, based on these numbers, how does Coface believe it will fare in dealing with the unprecedented surge of bankruptcies?
Well, Coface is a well-capitalized company. In addition to the capital that we have reinsurance arrangements. We've dealt with crisis in the past, and we react to the deteriorating credit environment by changing the coverage limits and, when possible, changing pricing parameters as well. So we take actions to preserve our balance sheet.
Thanks, Ken. Here's a question for Ruben. Do you think next year will be worse? And what should we do for our customers?
So hopefully, if our baseline scenario is right, meaning that the shutdown and the confinement measures start to ease in the second half of the year, well, we can hope that 2021 will be better. The main risk to this scenario is that there are further lockdowns or shutdowns to prevent a second wave of the epidemic. We've seen, especially in small city-states like Singapore or Hong Kong, that they had to go back into lockdown because they were seeing a surge in new cases. So that's why that would be the main risks that would make 2021 worse than 2020. If we don't see the second wave, I believe that 2021 will be definitely better than 2020, and that we will gradually go back into normality in 2021.
Okay, I think we have probably time for one more question. There is an overwhelmingly large amount of questions coming in that we'll try to answer and distribute the answers to the people asking the questions, but we'll go with one more question here. The question is, if the economies are at a standstill and payments do not really reflect the actual position, where does the role of credit insurance arise here?
I think I'm gonna start with the answer, and can maybe elaborate a little bit on that. But I believe that credit insurance will become very necessary when these payments are necessary again, and that we will probably see the increase in bankruptcy that we will see, and the increase in non-payment behavior that we will see will probably occur when the recovery starts. So that's why credit insurance is probably necessary during this time when when the shock is still ongoing, because when it's going to start to bite, it's going to start to bite very hard.
So credit insurance is not meant to cover losses that are fully expected, but to cover the unexpected loss for the unforeseen. So COVID-19 certainly is in the unforeseen category. Typically within the economic cycle, we see a pickup in claims as a leading indicator of a recession or downturn. This time things are flipped around a little bit because people are out of their workplace. There's so much uncertainty that we expect there to be a delay before we see the significant impact in claims. You know, we still have uncertainty, as Ruben indicated. You know, there could be a very sharp and quick recovery, but if we have the second round, because there's very little immunity to this disease, you know, it could be with us for a while and impact 2021 as well. But, you know, again, credit insurance is there to cover the unexpected loss, and that's what we've been in business for over 70 years doing.
Okay, we said there is definitely an overwhelming number of questions. We will try to answer them after the webinar. This today concludes our webinar session. We want to thank you very much. Thank you, Ruben and Ken, for being with us today. Thanks to everybody for attending today's webinar, and have a great day.
Bye. Have a good day.